So, what's going on? Video lesson number 3 coming at you. So, what are we going to talk about today? I have this little kind of sketch pad here or whatever. Today, we are going to talk about stock selection and risk management. So, what do I mean by stock selection? I mean exactly what it says. So, how do I know which stocks that I'm going to trade in the morning? There's a bunch of different criteria. So, what I've already done in the last video was I explained what my scanners scan for. So, the stocks have to hit a certain criteria to even be looked at. But then even if they meet the scanner, all of these stocks here, let me move this over because I can see my cam or my cam is in the way. So, if we saw this pre-market, how do you know what the hell to trade out of all of this? This is confusing, right? So, we look for stocks, and I think I went over this yesterday too, when I was talking about float. I was saying that, so we look for stocks with a low float, so the moves that they make will be exaggerated. So if you have 100,000 buyers, and there's less quantity available of a stock, so a lower float, then the stock will make a more exaggerated move because there will be less of it available, so the moves up and the moves down will be a lot bigger. So the volatility within there gives us the opportunity to capture 20, 30, 40 cents of a move per share, and if you're using 1,000 shares, that's $300-400. So if you have the same amount of buyers, so 100,000 buyers or shares, whatever, on a stock with a massive float, so like Apple or something, the stock might move from $170 to $170.20 or something. So there's not enough opportunity or volatility in there to capitalize on it. So that's why we choose a low float. We look for stocks pre-market that have volume. So this is the volume for the full day. I can't really show you what I see pre-market unless I go to an older video. I think I can I'll just choose a random video, maybe yesterday's live trading video, so we can take a quick peek. So it's 9:28, the market is not open yet, so I'm looking at 10x here at the top of the scans. It's already up 87% on the day before the market's even opened. So oh wait, you see that over there? Here, I'll try this. I will move my I'll move my webcam over here just for now so you can see this. So 10x with a very, very low, shares outstanding, so a very low float of under 1.5 million shares. So typically we look for under 10 million shares or 15, sometimes 20. The lower, the better. So very low float. The volume is over 10, 20, 30,000. So that's also a good sign because we want a stock that's actually moving. So if you look at FNGD here, sure, it's up 13%, but there's only 1,000 shares of volume. So it might be a buyout. Either way, traders are not trading it. So the moves won't actually happen because there's no one watching it. There's no eyes on it. There's no people trying to short. There's no people trying to buy. There's no people trying to sell. The stock just won't move. So you need something that will move. And also it has to be in your price range. So typically I trade under $10 stocks, usually between $2 and $5. But, 10x, it doesn't really matter even though it's like closer to $10. So that's how I choose the stocks. So you also have to look on the daily chart. So if we look on the daily chart for 10x, let me type this in after I figure out what's going on here. 10x. So looking at the daily, get rid of these lines. So looking at the daily, before this happened, because this was the actual day, as it started to pop up, right, I noticed that we had pretty much had room all the way up to $9. There's a bit of resistance because of these tops here, but the most resistance will be at $10 here. I'll move my camera back over. At the at the moving average, the 200 moving average, this is the 200 exponential moving average of $10. So it actually ended up bursting through that. So once it burst through that $10 resistance, we can see here that it consolidated nicely right before, right under $10 on the 5-minute, and then once the first 5-minute candle made a new high, we surged through that yet again, and then we had no resistance all the way up to the previous high here of $12.63. Now, we didn't actually make it past $12, but that just gives you an idea of how much room is available. So that, in a nutshell, is how we choose stocks. So it's not only about the criteria of them, like whether or not they have a low float and they look like they could be a home run trade or a great stock to trade. You also have to wait for the volume to come in to the stock so that people are watching it and people buy and sell and short it, and it works out. The patterns and stuff that you're working for work out. Sorry. Because without the volume, without people looking at it, it's just simply not going to move. And an example of that would be OGen. So it was gapping up. It was on the gap scanner. We can see here all day it did nothing until the end of the day, and it took half an hour and, you know, a couple 100,000 shares or something like that of volume only to move up 40 cents. Where with the right amount of volume, like on Elfin, this thing will move up, you know, $2 within a 1-minute candle. I can show you an example of that here. Back. I'll just pick a random candle. Okay, in this 1-minute candle, it went from $20 all the way up to $21, and that's because it had the volume to support it, and it had a low enough float that it could make that move. So I think that's enough for the topic of stock selection. If you have any more questions, or I'm probably missed something, I'm not entirely sure, just ask me below in the comments and I will get back to you. The other thing I wanted to talk about was risk management. So tomorrow or in the next series, I'm going to talk more about the actual strategy and when I buy and when I sell. But a big part of that is risk management. So you need to know when it's worth it to get into a stock. If your risk outweighs your reward, and usually people try and have a 1-to-1 ratio. So if you're risking $100, you're trying to make at least $100. So for a strategy that I'll explain in the next video, the first 5-minute candle to make a new high. So you're waiting to get in this move here and nothing's happening. Finally, there's a pullback and you're waiting for a good entry. So most people, or some people, would wait for the first 5-minute candle to make a new high. So at 1579 here is the high of this candle right here. So the first candle to make a new high after that, it did end up working out, as you can see, and it ended up retesting the high of day and actually going further by almost another point, or yeah, another full point. So for the people that got in here, they would typically have a stop at the low of the last candle. So from 1580 down to 1506, that would be 74 cents of risk. So you want to make at least 74 cents of profit if you're right. So if you were aiming for a retest of high of day, that would be at 1745 here. So I'm not sure what that is in my head. That's what, $1.65 or something. So over a 2-to-1 risk to reward ratio. So if you follow a proper risk to reward ratio, you know, and you're only right half of the time, your winners will be, let's say, twice as big or 1.5 times as big as your losers. So if you're right only half of the time, you will come out profitable. Now, if you have a risk to reward ratio of just 1 to 1, so your average winners are $100 and your average losers are $100, you have to be correct more than 50% of the time to become profitable. So if you win only $100 and your losers are $300, for example, your accuracy would have to be higher than 2/3, because for every 3 wins that you have, just 1 loss will wipe it out. So, or is that 4 to 1? But anyways, you understand there's 2 parts to it. There's the risk to reward ratio and your accuracy. So you either one of them they have to add up to be profitable, whether it's you're right more often than you're wrong, which should be the case for most traders once you get past the beginner stage, or your winners are bigger than your losers. So those are actually both things that traders strive for. Let's say to have a 60 or 70 or 80%, if you're really good, of an accuracy ratio, and also a profit loss of above 1 to 1. So that was kind of rambly. I'm not sure if that made a whole lot of sense. If you have any questions about that, please ask, and I'll do my best to answer it. This was kind of unscripted, so I'm just going off of what's on the top of my head. Hopefully that was useful. It's not as exciting as some of the other stuff I've been talking about, but risk management is by far the most important part of trading. So if your risk management is off, whether it's your accuracy or your whatever it is, then that is the reason that you're not a profitable trader. And if you're not profitable and you don't know why, look to your risk management, because I guarantee it's in there. It took me a while and some money lost to figure that out, but it's really propelled me and pushed me forward as a trader when I figured that out. So let me know if you have any questions. Thank you for watching.